Good morning, everyone. Welcome to At Home with Hayley. I am, of course, Hayley Andrews, and this is our webinar series. I think we're on about 56 episodes now, might be a little bit more, maybe one or two less. I'm not entirely sure. It's been going for so long. But this is a show where we talk all things property. We have industry experts come on. We do market updates. We've got a real treat for you today. Before we get started, if you can just let me know that you can hear me loud and clear in the chat box. Let me know where you're dialing in from. I know that we do have many internationals that join this call from all over the world. Morning, Mike. So you can hear me loud and clear. Morning, Felix from Hong Kong. So I can see people are coming through now. Okay, so we've got a real treat for you today. I thought it was super topical with, of course, the Bank of England's announcement yesterday of the increase to interest rates at 3%. And of course, the mortgage world being a bit of a minefield at this moment in time. Many of the questions that come through to me as a mentor, as an investor, as a landlord, as with people I'm networking with is what's going on in the mortgage world? What's kind of the best route forward? How do we know what to do right now? We're all in a bit of a kind of not a mess, but kind of confused. Do we fix? Do we go on a variable? Do we wait to remortgage? Do we remortgage now? What's the best route forward? So who better to talk to you about that than our wonderful broker, Mr. David Eva. Are you there, David?
I'm here.
Brilliant. So if you can turn your camera on so that our audience can see you. That would be fantastic. Good morning. Great to see you. I haven't seen you in person for a while, actually.
It has. It's been a while.
It has. I think your hair's grown since the last time I spoke to you.
That's good.
I speak to you a lot. I just don't see you a lot. Anyway, great to have you on the show. I know that we're going to have loads of questions today, as I think you're fully aware of. You've probably had everybody reaching out to you anyway, asking all of the kind of typical questions. So you're here as our kind of saviour to tell us exactly what to do, basically. No pressure. But while I load your slides, if you can kind of just give a quick introduction of who you are for those people that are on the call that have not met you, and let us know just roughly what you're going to be covering off today in your topic.
Sure. So for those who have not met me before, my name is David Eva, and I'm the Managing Director of the Mortgage Organisation. We are an independent broker, and we help people arrange finance for all types of reasons. I've been a broker since 2003. So I've seen the good times, the bad times, and these very peculiar times. I think that's what we're going to call them at the moment. It's very unprecedented. So hopefully by the end of this presentation, you'll actually see what's been going on, what's affecting it, and what steps we can take as investors.
Brilliant. Well, I'm certainly looking forward to it. So I'm going to hand it over to you.
Great. So the topics I wanted to cover today were really the Bank of England and the interest rate hikes, what have happened over the past year, and what the outlook for the UK interest rates is. Because as investors, we do really need to sort of think about what interest rates are going to look like in the future so we can make plans. I'll also discuss UK swap rates. For those who don't know about swap rates, this is what the mortgage market in the UK is based on. So it's really important for investors to know that. And because of all of the rate changes, a lot of the banks have raised the stress tests. So we would call that the interest coverage ratio. So we discussed those ratios and the changes to those. Also some key dates that you need to look out for in the coming months. Some alternative strategies that UK investors can pursue in this marketplace, because that's the most common question I get at the moment. What do I do in this marketplace? How can I position my portfolio in the right way so I can go forward and buy more properties? And we'll also finish on some questions and answers and some rates for international investors as well. Right, so starting off with the Bank of England. So why is the Bank of England so important? As you can see from the screen, the Bank of England has raised interest rates in its last 8 meetings. It started out with smaller increases, and it's now gradually raising the rates. And now it's made its largest rate rise of 0.75% in one meeting. So this is illustrated here in this graph here, where you can see where we were for an average 2-year fixed rate at the end of last year to where we are now. There has been some significant changes in the market, and it's caused a lot of stress to a lot of people. So why is the Bank of England so important to investors, and why should you place a close attention to what it says? As a reminder, the main objective of the bank's Monetary Policy Committee is to set monetary policy to keep inflation low and stable. The MPC is also required to support the government's economic policy. This is something that went awry under the Liz Truss government, which has partially led us to where we are today. As a reminder, the government has set the Monetary Policy Committee a target for the 12-month increase in the Consumer Prices Index, inflation, of 2%. And the last Consumer Prices Index report was 10.1%. So this is well above the target set by the government. So the Monetary Policy Committee has had to take action to bring inflation down. It's important, therefore, for investors to understand what has caused inflation and where it is heading, as it is an indicator of how the Monetary Policy Committee is likely to act going forward. So what have the main causes of inflation been? So we've had the increase in the energy prices due to the war in Ukraine, the breakdown of supply chains following the pandemic, the shrinkage of the workforce, and the fall in the value of sterling. So in his forward guidance to the market yesterday, the Bank of England governor said at the press conference, and I quote, "From where we stand now, inflation will begin to fall back in the middle of next year, probably quite sharply." So if we look at that chart on the screen, we see that inflation, in their view, anyway, the bank's view, that we're going to peak towards the end of this year, and then gradually it will come down next year, and then in 2024 we'll actually be below target. He then went on to say, but where we stand today, the bank rate will have to go up less than pricing to financial markets. Now, to me, this was the most interesting comment of the entire press conference. He was essentially daring the markets to push back from where it is today. And this is something new that we're hearing from the Bank of England governor. There is one huge caveat, though, with the bank's inflation forecast. It's assumed that the government will continue to provide assistance to the energy support scheme in some guise, for 18 months rather than 6 months. So if the government does not announce a sufficient package, it could affect inflation. So some really, really interesting comments coming out from the Bank of England governor yesterday. A couple of other quotes I've noted down are, the committee will not pursue a path that will drive inflation far below target. And also the MPC does not follow the market. It sets the level of bank rate to return inflation to the 2% target sustainably and avoids undesirable volatility in output. So to me, these quotes show the MPC, the Monetary Policy Committee, is well aware of the lag effect of raising rates to the economy. We are yet to see how the previous rate increases will filter through to the wider economy. So it's good to hear they are mindful of the effect of continuing to raise rates and the potential consequences. So in summary, though it's not great news for investors that the bank's risen the bank rate for the 8th meeting in a row, the Bank of England is signalling to the market it may not need to keep increasing the bank rate, and that they have a shallower path for interest rates than the market at the moment. So investors should consider that rates are beginning to peak and could in fact fall in Q1 2024 based on the bank's current inflation forecast. Okay, so moving on to swap rates. So swap rates, what are they and why are they so important for property investors? So swap rates are when two parties swap interest rate payments for another. So one party agrees to receive a fixed rate payment while the other receives a variable rate payment. Simple. So in the case of mortgages, it's what lenders pay to financial institutions to acquire fixed funding for a set period of time. So the cost of swap rates is used to price mortgage products for lenders. As swap rates are based on what the market thinks interest rates will be, if they rise, then mortgage lenders will increase their pricing to maintain their profit margin. Or if they raise too rapidly, then they may have to pause lending or withdraw products until pricing stabilizes. That's exactly what we've seen in the past few months. If we look back to when Kwasi Kwarteng did his mini budget, the market shot up. So that's around about September time. So that's the peak of the swap rates there. And that's when lenders paused lending and withdrew products because they just didn't know what the outlook was going to be for the swap rates. It was just moving too fast. So this chart shows the swap rates for SONIA. So SONIA is the Sterling Overnight Index Average. Now this replaces the old benchmark called LIBOR, which some of you may have heard of. So moving on to the next slide, this demonstrates the various rates, so the various types of fixed rate swaps available and how they have moved over the past year. Now I've printed out or taken screenshots of these two swap rate tables. One is at 9 o'clock yesterday morning before the bank raised the rate, and then there's one at 4 p.m. after the bank had raised the rate. So looking at these tables, we can actually see that a lot of that information that came out yesterday was already priced into the market. If we just look at the top line there, the 1 year, the current rate at 9 a.m. was 4.158, and at 4 p.m. the same day, it's at 4.166. So really the market hasn't really reacted to that increase in rate because it was already thinking it was going to happen. So it just really goes to show a lot of this news at the moment is priced into the market. Now, I'd encourage everybody to keep track of these fixed rates because it's essential to understanding what way the market's thinking it's going to move. And at the bottom of the screen there, you have the link you can use to actually keep in touch with what's happening with swap rates. But I thought it was really interesting, so just to show you how that news is already priced in. Now, if we look back to 1 year ago, we can see how far we've come with swap rates. If you look again on the first line, the 1 year SONIA swap was 0.688, but it's now 4.158. There's a massive change from 1 year ago. And if you look as well for the outlook for long-term interest rates, and this is a key thing for investors to think about, so the 30-year swap rates and even the 10-year swap rates, the 10-year swap rate was at 0.9 and now that's at 3.6. So that's really indicating now that we're in a new interest rate environment. The days of 1%, 2% mortgages is probably over for a while at least. The market seems to think that the long-term outlook for interest rates is much higher than it was. In fact, 3 times what it was this time last year. So, stress test changes. So because interest rates have risen, a number of lenders have actually now started to increase the stress test. So why does that matter to investors? Well, the reason it matters to investors is because the stress test is what drives the loan size that you can borrow. Now, on the left-hand side is the stress test now for one of the biggest, if not the biggest, buy-to-let lender in the country. So Birmingham Midshire is part of Lloyds Banking Group. As you can see from the table on the left-hand side of the screen, their stress test is now based on the income of the individual and whether it's a 5-year fixed or less, or if it's a like-for-like remortgage. Now, if we go back again a year, the stress tests for people like Lloyds Bank even were as low, also with BM Solutions, were even as low as 4.25, working on the base of that if you have a good credit rating, a good credit score. It just really goes to show how much more yield the investor is going to need if they're going to apply for mortgages with the high street banks. Another example on the screen there is from Skipton Building Society. I just cut and paste that from their website. They're now as high as 6% if it's on a 5-year fixed, or 7.76. I think that's what it says. I can't really see that properly in my photos over it. And yeah, it's just much higher. So if we also look at the final one on the screen there, Leeds Building Society, they've now decided to stress test the wider portfolio. So if you're a portfolio landlord and you have multiple properties in your portfolio, look at that stress rate you have to beat. You have to beat 7% at 145% across your entire portfolio to qualify for a loan. So these are significant changes in the way banks are deciding what to lend, and it will impact investors. So I'll put a note at the bottom of this slide to say, look, we have access to other lenders who will do their stress test on the old method and actually base it on the interest rate and not a notional rate like these mainstream lenders are doing. So it really is about selecting the right lender if you want to go for a higher LTV mortgage, because it looks like unless you've got a really high yielding investment, you're going to struggle at the moment to get on the mainstream. And here's just another example for you. This is from the Mortgage Works, which is Nationwide Building Society, says in one of the biggest UK lenders. Their stress tests have increased as well. So if we look at the trackers, I mean, that was the one that really stood out to me. So for a non-limited company, it's the pay rate plus 5%. And then you've got to beat the stress test on top of that as well. So if you're a low rate taxpayer, it's 125%. And then if you're a high rate taxpayer, it's 145%. So it just, again, illustrates how challenging it's going to be in this marketplace at the moment to get onto the mainstream and get the bigger loans, which is what most investors want. They want to have a higher loan to value, because if they've got more cash, they can buy more properties, which is understandable. But the banks, unfortunately, at the moment aren't seeing it that way. Right. So here are some of the key dates you want to put in your diary. As we mentioned at the start of the presentation, CPI, so the Consumer Prices Index, you want to be following that, because if the data comes out lower, that's good news. If it comes out higher, that's bad news. So keep track of that. GDP data as well. Those are the dates on the screen. And for me, probably this is the biggest one out of them all, is the next statement from the Chancellor. That's due on the 17th of this month. And I put a note there on the screen. Will the government extend its various energy schemes? Because as the Bank of England said in this press conference yesterday, they have assumed that the government will give assistance for 18 months rather than 6 months. So fingers crossed, everybody, they do that, because for investors, that's the signal we want to hear, that they are going to support people and businesses with the various energy schemes, because we really need to keep inflation down, because that really is the main metric that the Bank of England use when they are deciding on interest rate policy. Right, so what strategies can investors do in this turbulent marketplace? So one of the first things you could consider is looking at higher yielding investments. So the most obvious ones on the screen there are multi-unit freehold blocks. So that's a block of flats, HMOs and holiday lets. Now let's take them one by one. So with multi-unit freehold blocks, you'll have multiple flats. Typically you'll have a block of flats, and that block of flats doesn't need to be a big sky rise. It can be even 2 flats on one title. So anything from 2 upwards. So if you have more than 2 flats on one title, we would call that a multi-unit freehold block. And you tend to find that they have higher yields. So they would be a good place to look for new acquisitions in this marketplace. And there's plenty of mortgage companies now who are offering multi-unit freehold block mortgages. HMOs. So HMOs are quite good in an economic downturn, actually, because lots of people will want to have their own room rather than renting a whole place. It's actually cheaper for them. So in a way, HMOs could be a good strategy at this point, because it's a high yield investment, and also we may see more demand. And holiday lets, so Airbnb style properties, there is the opportunity to actually make more money from a holiday let, potentially, if it's in the right area. Big caveat there. But there's lots of appetite now for holiday let mortgages. That market has grown and grown and grown over the past 2 or 3 years. And there's more and more lenders who are operating in that space. So consider maybe a holiday let mortgage, but be mindful, it must be in a holiday let area. So we're looking for things that are in a rural area, a coastal area, or in a city centre. Those are sort of the 3 main things. Right, so I've made a note there on the slide there to not panic at the moment as well. If you've got a fixed rate that's coming to an end and you're worried about that, please don't be worried about it. There are ways to deal with the fixed rate ending. But really go back to your portfolio if you're not doing this already, and know exactly when the fixed rates are ending, because a lot of lenders now will consider offering you a new rate 6 months before. It also gives you time to plan to maybe even refinance as well, because if the fixed rate that they're offering is too high, that's the opportunity, that's the window of opportunity there to look around in the marketplace with brokers like us, and then we can see what's out there, but if you don't need a mortgage now, it's a good idea to wait, I would say, and see what's going on. Right, so I've put together some more slides of where the market is at the moment, so we can talk about certain strategies, because bearing in mind what I said earlier on about inflation, well, the Bank of England thinks that inflation may have peaked, and they're thinking it's going to come down next year and then further into the end of the year. Should we be taking a fixed rate mortgage anyway? So at the moment, I did this morning just before we came on now. This is a sourcing result for a fictional client called Mr. Joe Blogs. He's looking for a buy-to-let remortgage. His property value is 100,000 and the loan amount is 75,000. I just made these figures up just so you could actually get a flavour of what's out there in the market at the moment. The lender panel is, I've searched the whole market. It's a fixed rate mortgage on an interest only basis, and the duration of the fix is between 0 to 27 months. So just trying to capture sort of 2 year or thereabout 2 year fixed. So at the bottom of the screen, you'll see the results. I'm sorry it's in small writing, but I just wanted to sort of demonstrate the list of lenders that come back from the results that we do. At the top, this morning was Bank of Ireland for intermediaries, and their best 2 year fixed, bearing in mind all the costs, because when we run these calculations, we think about all the costs. So that'd be surveys, arrangement fees, and even cashbacks, you know, that will filter in. So at the moment, this morning, 5.89 was the best 2 year fix that we could find. Now that, compare that, same case, for a 5 year fixed, how is that coming out? So at the top there is Principality, although that's for a holiday let. Let's look down just 2 more. 5.89 again for the 5 year fixed. So we just quickly compare that again. So we've got 5.89 for 2 year, 5.89 for the 5 year. So there's not really much difference at the moment between the 2 and the 5 year fixed. So what's the other strategies we can look at, right? So one idea that you can consider if it is due to remortgage at the moment, your portfolio, is a variable rate. Now this search, same client, Mr. Joe Bloggs, buy-to-let remortgage, but this time we've excluded the fixed rates, we've included all the variable rate mortgages, and we've also added another condition that we want no early repayment charges at all. Okay, so the benefit there is if we have a mortgage with no redemption penalties, we can then pay this mortgage off when we think you know, rates are going to rise again. Sorry, what rates are going to rise again, when it's going to be more beneficial, because I think at the moment rates may go up a little bit more, but we really want to be thinking about, we're not going to benefit from any downside if we've got a fixed rate mortgage. And based on what the Bank of England is saying, we may have reached the peak. So if we look at the results from this particular sourcing results, Paragon have come up the top there. So that's a 3.99. So that's really 2 percentage points below what the current 2 and 5 year fixed rates is. So really we'd need, what, 2, you know, how many rate hikes is that from the Bank of England? I mean, you know, are they going to go another 2 percentage points higher? That would then say the base rate's at 5. You know, that's certainly not what they're saying at the moment. They're saying that they think the market's got it wrong, in so many words, and that they're overpricing the risk. So maybe taking the variable as of today might be the better option if you're prepared to take that risk, I should say. Huge caveat there. But you know, you're going to get the downside as well as the upside, but you won't get that with a fixed rate mortgage. So that was for an individual. This is for a company mortgage. So we get it in the same results pretty much for the same case. Now, another option for those investors who really don't like the thought of having a variable rate mortgage is we're seeing more 1 year fixed mortgages coming out. So for the same case, Mr. Joe Bloggs, 100,000 loan amount, 75,000 fixed rate mortgages for 1 year. The lowest cost mortgage there was 5.64, but there's also some there at 4.99 as well. So it just gives you another idea. If you really are dead against the variable rate, that the lenders are adapting to the situation and they're coming up with new product ideas, such as 1 year fix, which is relatively a new concept, but we've not really seen that before. Okay, so that was for companies. This is for individuals. So we're still getting the same results for individuals and companies, which is quite rare, to be honest. Traditionally you would think that the convention normally is that the individual mortgages are cheaper than the limited companies, but at the moment, they're pretty much the same. We're getting the same results, but this is where it makes a difference here. So on the 1 year fixed for an individual rather than a company, it is a bit cheaper. So you can get the rate down there as low as 4.64 for a 1 year fixed. And I guess at the end of the 1 year, you can then look to renegotiate the rate potentially with the bank or move on to a different lender because the penalty clauses have ended. Right, so that's the update for the UK investor. Here is the latest update for international investors. I'm sorry, it does look a little bit grim. These are the rates as of today, but we do have a couple of lenders who are out of the market at the moment. We are hoping that after the Chancellor makes its announcement on the 17th, that these will come down a bit, because at the moment, I mean, they are just, they are quite high. And we don't really have the option of a no early redemption charge mortgage like we do for UK investors. So unfortunately, that is the position as we stand today. Okay, but if you hang tight, I think this will come down, because really what will end up happening is that they just won't have enough business, and they'll have to drop their rates to get business through the door, because when we're looking at these type of rates, the stress rate is too high, so therefore it will just dampen demand. It's just too high. So fingers crossed that comes down at the end of this month. Right, so how can we help you? So as a broker, we work for you, and we don't work for the lender. I've been a broker now for nearly 20 years. So I'm very familiar with what the lenders like, what they don't like, and my job really is to be a matchmaker. There's no point me taking you to one bank just because they've got a good rate, but ultimately they're going to refuse the application. So we'll act in your best interest and make sure we try and get it right first time. We have access to software, which we update daily, so we will constantly get the best rate for the investor on the day. We're very familiar with the criteria, as I said. Dealing with them on a daily basis, you just get used to the things lenders like, the things they don't like, the properties they like, the case they don't like. So it's one of the main advantages of working with us is that you're working with an experienced broker who knows the lenders inside out. And then I guess the final point I just need to let you know about our service is that we do offer a free review service. So when it comes around to your fixed rate renewing, or you want to change that variable rate, we can arrange that for you, and there's no charge on our side, and you get advice. Okay, there's my details on the screen if anybody wants to contact me after the presentation. And if you want to ask any questions, please feel free to do so.
Brilliant. We have got some questions in the chat box, and we've had quite a few questions sent through as well. So are you okay for time?
Yes, sure.
Good. Right, so we've got a couple of, I always address the questions in the chat box first of all, because those are the people that have turned up, while some people that have sent their messages through to me and to the team are on the call, some of them are not. So we'll always prioritise those that are live. So in the chat box, we've got a question from Amy. It's a really good question, actually. So she's asking, what's the impact of property prices coming down on remortgaging?
Yeah, I mean, we haven't really seen much movement as of yet, but I think there is a prediction that prices are going to fall. We're not actually seeing that just yet, but if the surveyors do start down valuing, is the phrase that we use in the industry, the properties, then it will affect remortgaging. But me personally, I'm not seeing it as of yet, but I can understand the question. If that does happen, then yes, it will start affecting the bank's ability to lend. I mean, I think the bigger problem investors got at the moment is not necessarily the values, it's the rental stress test. Yeah. Because they've raised the bar so high. It's going to be really tricky to get the higher loan to value mortgages.
So just in your slides just now, I saw very briefly HMO stress tested 170%. Is that right? With
that particular lender, yeah.
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 Okay.
So that's, yeah, it's not every lender that does that, but yeah, some of them will actually raise the stress test on an HMO.
Okay. But obviously with a HMO, of course, the income is much higher and the risk is spread across several different tenancies as well. So I guess there's kind of comfort there, isn't there?
Exactly, yeah.
Also, the demand for HMOs rooms is absolutely ridiculous. I just can't buy them quick enough. So if anybody's got any HMOs in the Black Country, do let me know, because we've got queues of tenants waiting to move in. But yeah, a great question, Amy. Thank you for that. I'm not seeing any down valuations at this moment in time, and I've had quite a few recently. So, but we'll see. You never know until you
watch this space.
Yeah, watch this space. But yes, I think we will start seeing some kind of pullback, just because naturally, of course, the demand will drop off because the affordability won't be there, and of course, the lending criteria being stricter will reduce the number of people that can buy, which will naturally reduce the demand even further. So prices will drop slightly, I think, but of course, we don't have a crystal ball. And time will tell.
I think we've got to remember as well, the pain investors are feeling is the same for like a first-time buyer or any other person. Yeah. You know, it's not just investors, you know.
Yeah.
So yeah, affordability is an issue. Absolutely,
it's an issue for everyone. Absolutely, everyone's feeling it. So yeah, I mean, anyone that's kind of ignorant or naive to think that this won't affect them and their business is very much hiding under a rock and needs to kind of face reality and make sure that they're looking at putting plans in place and they've got reserves. And that they are investing in much higher yielding properties and picking those much more wisely. I mean, I most certainly won't be buying flats in London at a 2 or 3% yield. It just wouldn't stack. Not that I ever did do that anyway. It's not my type of investment, but yeah. So definitely seeing a change in what people are looking for and more people searching for HMOs. You mentioned serviced accommodation in your slides. I haven't seen many people actually looking, because of course we've got a sourcing platform as well, haven't we? And I haven't got many people that are actually searching for serviced accommodation investments, although those that are doing serviced accommodation are doing very well out of it. What do you think about that? You know, do you think it's just not people catching on that, you know, their standard kind of normal 1 or 2 bedroom houses on the seaside or in a town centre location are stacking up much better on a short-term stay basis?
Yeah, I mean, I think availability of mortgages has been a problem for that part of the market, because before people were doing it under the radar.
Yeah.
You know, they were doing it and then have a mortgage and not tell the bank.
Yeah.
Really, you should never do that. But because people have done that, it's opened up more and more lenders coming into that space now. So, I mean, I'd certainly encourage people to actually investigate more with holiday lets, because the potential is definitely there if you've got the right area. and it just gradually grows that business, doesn't it? You start off a bit slower, but once you start getting a track record in the holiday let business, especially on Airbnb, you get good reviews, then you'll see more and more people wanting to stay at your property.
Yeah, absolutely. I mean, sorry, echo in there. Just on that as well. So are they still looking for kind of 2 years worth of or a feasibility?
Oh, it's completely changed. You know, from when I first started doing holiday let mortgages, like we now, if it's a new business, I mean, in many ways, that's the easier way to do it because we work off projections.
Yeah.
So there's a lot of lenders that we go to where they'll get a projection from a holiday let agent, and they'll ask them, you know, what do you think it will let for in the high, medium, and low seasons? And then they take an average of those three, and that, in a way, as long as those figures stack up, we can get the loan. Whereas if you're going to someone who's starting out in their first year and they've got actual figures and they're not doing so well, then actually it's a bit harder to get the loan. So in many ways, it's better to sort of go into it a little bit blind, but you'll get the funding.
Yeah, I mean, certainly for me hasn't been an issue for a while, but I do remember it being more difficult when I first started out, because I tend to buy in the same areas, and I've got obviously businesses that are showing exactly what the revenue is, and we've got direct comparables and can show occupancy and things like that and void. So profit, loss, all of it. So I guess it still always does get easier, but we are seeing more and more lenders, I think, operating in that space and more confident that that's kind of a way forward and people's, you know, more preferred way of staying short term, isn't it?
It's true. Staycation is back in abundance, you know, ever since the pandemic and people couldn't travel. I mean, I even speaking up from my own personal experience. Yeah. You know, I go on many more staycations than I did before.
Yeah, same. Yeah.
So, you know, I think the demand is only going to go up.
Yeah, completely agree.
Especially because it just costs an absolute fortune now to go abroad as well, doesn't it?
Yeah.
You've got those shocks to deal with as well. So, you know, I think holiday let sector's in a really good space, to be honest.
Yeah, fantastic. Okay, well, that's good news for my portfolio. Another question then. So we've got Raj. So I'm in the process of buying 4 buy-to-lets currently in the northeast of England. In the current climate, it's not going to work then. Are they together under one in a block, as David said, Raj, or let us know? But what's your kind of opinion on that, David?
Well, you can. I mean, there are lenders that do portfolio mortgages. So just because one might be too small, then if you add them in together, it may work. But yeah, it is again going to come down to the numbers, and also it may be better if you're a high rate taxpayer, that is, to put them in a company, because the stress test is going to be easier to beat if it's in a company. So it's one of those ones that you need to really do your planning before you go into it and speak to people like us, because we can actually show you, you know, what's available mortgage wise.
Yeah, absolutely. So did you say that in a limited company it's still 125%? But in the way of name 145, was it?
The thing is, everybody does it differently, and that's like one of the reasons that people should use a broker, is because like we will know that type of thing. You know, the examples I've given today, they're really for the mainstream banks, and if you're an individual, because the mainstream banks don't really lend to limited companies. So like even like Birmingham Midshire, the biggest lender in the UK for buy-to-lets, they don't lend to limited companies.
Yeah.
So you have to go to the right lender. But yeah, some are still doing it, some are not. But it just really just to demonstrate how much the markets move, really, especially if you're buying or you've got properties in an individual name. It's going to be quite tough to get the higher loan to value mortgages.
Yeah, absolutely. Raj has just confirmed 3 with one mortgage broker and 1 with another, so they're all separate.
All right, so they're 3 separate applications.
Yeah.
Good luck. Yeah.
Roland has asked a question. So may I know if I am coming to the UK and live there in March 23, am I considered as not an international investor in terms of the mortgage rate?
Yeah, I mean, we get asked this question quite a lot, actually. You will be, yes, for a while, for a year or so, probably 2 years. Interestingly, though, if you was going to get an owner-occupier mortgage, that will actually be easier than getting a buy-to-let mortgage. So if you do move here and you're thinking of buying somewhere to live and you've got a job, I mean, that's the key thing. You can't apply while you're still overseas. If you're going to come here and not have a job to start, you need to have a job here. Then there's lenders who will just base it on your credit score. So if you can work on building your credit score up, then 6 months, I mean, we've done them, I think, about 9 months to a year where someone's lived here, and we've managed to get them through. So there are lenders out there who will lend to sort of non-UK nationals, providing they're living here and they've lived here for about a year.
Brilliant. And what about, sorry, there's a bit of an echo on my side. I think it's my speaker. I do apologise. So what about kind of your unconventional lenders, such as you Sharia products and things like that? I mean, are they still available or?
Sadly not, no. At the moment, they're out the market.
Okay.
They were just inundated with applications, so they pressed pause for that reason only, and that was before all of the shenanigans with the mini budget.
Yeah,
so that's what happened to them. But they're still going. It's not like the bank's in trouble or anything. It's just they've got such a massive pipeline. They're dealing with that. But I think they'll be back this month as well, because their pipeline's pretty much depleted now. Yeah.
Okay, fantastic. And just from your point of view, and then I'll get to the questions on here as well. Are you seeing kind of less investors coming through to do buy-to-let, standard buy-to-let, as a result of everything that's going on?
Absolutely. I mean, it's had a big impact on our business for the reasons I've already stated. Really, it's about the stress test and also the rates as well. I don't think people are prepared to pay those rates, and they wanted to sit and wait and see what happens. So we're gradually getting more clarity where the government's going, and that was the big problem with the mini budget, is that it just looked like the government was just going to borrow so much money it was going to balloon out of control. But it looks like that's going to stabilise now. So fingers crossed it does come down, and I think it will, because if you take the Bank of England's comments into sort of consideration, he's quite clearly saying to the market, I think you've overpriced this risk. Yeah. So he thinks it's going to be lower. Okay.
So we've got a question from Mike. I'm pretty sure Mike's an expat. Do you want to just confirm that, Mike? Because we have lots of people. It's hard to remember everyone, but I do remember Mike. He's in Sweden. I'm pretty sure he's an expat. So we started a refinance project a few months back, unfortunately not with TMO. As far as I know, the process is ongoing, but is a bank, in this case, the Hampshire Trust, likely to apply the new stress test, even if the offer was based on the old world tests? What's your view on that?
No, I mean, if you've got the offer, then the it's done. They're not going to revisit that. But with Hampshire Trust, they have set conditions that the mortgage has to complete by the end of the year. So if it doesn't complete by the 31st of December, they're not going to honour the old rate, and then you will have that problem of the higher interest rate and the higher stress test. So really, you need to sort of drop everything and make sure you know where you are with your application, and just be very responsive with the solicitor if they need anything, because if you miss that deadline, you're just not going to get that type of deal this side, next year.
And what I am seeing, because I've gone through quite a few remortgages, luckily secured the rates just before the budget, the mini budget, and a few months before that as well. So not hit massively, but what I did see was the lenders really dragging their feet in terms of the legal side, and really waiting until the last minute to ask this, that, and the other, and almost wanting you to fall outside of that agreement because and making it the hardest that they possibly can for you to meet the deadlines. Are you seeing that as well?
Well, I have to be objective what I say here, but
yeah.
But yeah, I mean, I can understand why you would say that.
I'm just saying, like, from my point of view, don't sit on your hands. If you've got an offer, that offer will be honoured, but make sure that you're getting that through in time, be in constant contact with your solicitor and your broker, making sure that any questions that need answering are answered and they're not relying on anything from you, your side. Because if they are, and you go outside of that, you know, you lose that rate basically, and you lose out. And it's almost in their interest. I'm not suggesting that they're doing it, you know, well, there was one time I kind of thought, come on, you're having a bloody laugh here, you know, but you've got to make sure that you're on the ball, you're showing up, and they are not waiting on you in any shape or form, and constantly saying, do you need anything else from me? Is that everything you need? And being super assertive, because the last thing you want is going down to 1 or 2 weeks before you've got to complete, and it doesn't happen.
Do you know, Mike, I would say to you as well, if your case was done 9 months ago, that does sound an awfully long time. Even for their standards, you need to be mindful of your survey because they're only valid for 6 months. So you don't want to find out at the last minute you need another survey. Best find out now, as unpalatable as that is, having to pay for another one. Find out, because if your survey has already expired, they're not going to complete on the loan, and you don't want to find that out in the middle of December because it will just be too late.
Yeah.
And in fact, surveyors are starting to get busier now because Christmas. You'll find that, you know, they won't want to go out over Christmas. So find out where you are with the survey.
Mm-hmm. Yeah, great advice. Brilliant. Okay, so few questions. I can't see any more coming through, I don't think. So yes, Mike is based in Sweden and he is an expat as well. I retired and able to cash. Oh, so I've got one more in the chat box. Roland again. I actually can't see that. As I retired and able to, sorry, I am blind as a bat. And the screen's so white as well, so it's really hard to see the writing. Can you see it, David?
No, I can't actually, no.
Buy a cash buyer. I apologise if I'm reading this out wrong, so I'm going to read the gist of it. I think that should be, as I'm retired and able to be a cash buyer, but I still want a mortgage to leverage to buy more properties. Can this be done? And what would the mortgage rate be like? Thanks. I do you know what? I'm really struggling to read how small this is.
Yeah, I mean, the thing is, believe it or not, income isn't the biggest driver sometimes for banks, because ultimately, your income isn't paying the mortgage, it's the rent. Mm-hmm. So that's why that stress test is key for the bank, because they want to make sure that the investment can service the debt. But you being retired isn't necessarily an issue. It will restrict the number of lenders that will work with you. Yeah, that's for sure. But it doesn't mean you're just completely disqualified from applying for a loan. So it's one of those ones we need to dig a little bit deeper. But it wouldn't overly worry me straight away that you're retired, because there's plenty of lenders where you don't even need an income. So
they're still looking at the asset itself, and obviously the income that generates, as long as it meets their stress tests. And you have to have a minimum amount of income, though, personally, even though it's not calculated. No,
I mean we do have mortgages for housewives. Or housemen, I'm sorry, in this day and age.
Yeah. Oh, you get in trouble for saying that.
Homemakers, that's the right phrase. Sorry.
Love to be a housewife. Go back about 40 years. And go out of my mind. Right, so I'm going to pop across to a few questions on that were sent through. We may not have time to go through all of the questions because there was quite a few and we've got a few minutes left. But I'll get David to answer them. and we'll get admin to send them out to you personally. There is one that's anonymous, David, and I'm going to get that sent through to you anyway. They've asked for their name not to be displayed. I never do that anyway, unless you're live. But I'm on a bridging loan that's coming to an end and I'm panicking. So that's kind of any advice. But I think that's going to need a bit more investigation and obviously
don't leave it to the last minute. Because the planning phase, you need to really get your ducks in a row as soon as possible, really. So get in touch as soon as possible, and then we can look at that immediately.
Just to that person, I'll do an email introduction if it's okay with you to David, and you guys can have a conversation and have a discussion off air. Now is not the time to answer that question, really. So another one. I think you've kind of answered this one already. Who will be your typical type of lender in this market, and what's your opinion on crowdfunding?
Oh. Crowdfunding, we don't really get involved with because, it's not mortgage related. I mean, I really haven't got anything to say about crowdfunding. I'm sorry. But your typical type of lender, I mean, it's so difficult to answer that question because, there isn't such a thing as a typical lender these days. That's one of the reasons why you use a broker. That's why I mentioned the phrase matchmaker earlier on, because that's what I feel like I'm like these days. It's not necessarily about, right, well, who's got the best rate? It's who's got the best rate, but they will like each other.
Yeah.
So really, there's no such thing as a typical lender out there these days. I would just say is that just from an investor standpoint, really need to be thinking about the yield. The yield is just so key at the moment. You've got to have a high yielding investment if you're going to get a big loan to value mortgage, and there's so much liquidity in the market. I know the rates are a little bit higher than they were, but there's still lots of appetite to lend. There really is.
Okay, just
for the right deals.
Just to kind of finish that question off, then, just for the audience, what starting point from a yield point of view do you think they need to be looking for in their investment?
So really, we need to be, I would say, probably 8.5%, 9%. That's where we need to be.
Net?
If we're going to go mainstream.
Gross yield.
Gross, yeah. They don't take off letting agents fees and things like that. So it's the gross.
Okay, perfect. We'll do one more question and then I'll leave it. I'll get the rest of them answered with you at a date in the future and get it sent out to the individuals. I'm just trying to pick up one that actually you haven't already answered because most of them are about the market scare, the mini budget. What's been the most common, I'm kind of just, this is a really long question, but I'm just shortening it. What's been the most common or the thing that you've seen, the criteria you've seen change the most during the last few months?
Well, honestly, we haven't really seen much criteria change apart from the stress test. Said just in the previous answer, there's so much appetite to lend. The banks are full of capital. They want to lend it out, but they don't want to be the last man standing in the room. So when one raises rates, the others will follow. And when one raises their stress rate, the others will follow as well. They don't want to be left with all of that business that nobody else wants. Yeah. So, please don't think the banks don't want to lend or the criteria is changed. It really is. It's just you've got to have high yielding investments really to make it work at the moment.
Okay. Brilliant. Well, that was a fabulous session. I'm sure everybody will agree in the chat box, and those that wasn't able to attend live will have a real treat watching this back, David. Thank you ever so much for your insight and confidence in it all, and that level head that we all kind of need to listen to sometimes instead of going insane and panicking. Yeah, it's funny, isn't it? But yeah, anyway, I'm going to say thank you ever so much. It was an absolute pleasure. I'm just going to quickly, you can either jump off or you can listen to what events we've got going on. But I'm closing up in about 2 minutes. And then I'm going to say a good Friday to everyone, and thank you to you as well. David, I'm just going to now jump on to the events that we've got. I am going to have to move these settings because, so there we go, pop me down here. Right, okay, so for those of you that have not attended before, we've actually condensed this down to a one-day event to make it easier for people to attend. And this is both live and virtual. So if you are international, you can attend virtually, and we live stream that session. It's fully interactive. We've got all of the mod cons and equipment to make you feel like you're in the room. You engage with everyone that's in the room as well. These seats are selling out fast, and that's not a sales pun either. This is our last event of the year. It's one day. It's on the 26th of November. It is all about what's going on in the current marketplace, what strategies. Of course, David has just spoken about what strategies you should be working on. It's both for UK, international. We get people that join from all over the world: Hong Kong, Singapore, Australia, New Zealand, South Africa, Sweden, the Netherlands. It's a truly international event. If you can come live in person, that's fantastic. We'll be here in our training headquarters. For those of you that do attend live, I've got several projects on within walking distance. So in the lunch break, we always have a walk round, talk you through figures, look at finish, things like that. So you can actually see we practice what we preach. We're active in the current marketplace. We feel everyone's pain, and we can kind of tell you what we're doing right now to protect ourselves, our investments, and the strategies we're working on for the next year or two. So absolutely phenomenal event, jam-packed. Bring an extra pair of socks because we will definitely knock them off. I thought that was a pretty good joke, but I like all my jokes. So you can see the QR code on screen now. You can scan that and join us on the next event. That is Saturday, the 26th of November, and it's all day. For those of you that don't know, I'm one of the experts on Sky Property Question Time, and we have a show on Saturday at 8 o'clock on channel 168. And all of the channels, all of the episodes that I've been on previously as well are all on our YouTube channel. For those of you that don't have Sky, we do premiere the episode that's broadcasted on live on the YouTube channel as well, so you can catch it up on there. It's many different panelists, all experts within their field, talking everything about property. The questions come from the audience the same, and it is on Property TV. And then for those of you that are looking just to have a conversation, so you're actively investing, you don't have to be part of your Freedom Empire to book in this call. It's not a sales call. It really is just to discuss your options. You can book this in by using the QR code on screen now, or pop along to our website, yourfreedomempire.co.uk, and click on the Education Hub. And on the option menu, you can book in a call with an expert. That will be with myself or one of the YFE team, and you can specify who that call, who you want that call to be with. And then just before I say I love you and leave you, as I always do, I want to announce that Hannah and Mario from Sweden won our Swedish 90-day accelerator program challenge. I just want to say this was by far the best challenge application that came forward to us. They took our mastermind session, and then had addressed this 90-day challenge, which was a huge challenge. A lot of investigation, a lot of work, and a lot of love went into their application, and I was absolutely blown away with them. So congratulations to them. Hopefully you'll all join me in congratulating them as well. Hannah and Mario, if you haven't already, reach out to admin@yourfreedomempire.co.uk and claim your prize. But on that positive note, I hope that you've enjoyed today's session. I most certainly have. Thank you for those of you that have joined us live, and hello to everyone that will be watching on YouTube and catching up on there. Make sure to, if you are on our YouTube channel, you like and subscribe, and put some comments in the chat box as well. We can address them and answer your questions there also. But I'm going to say have a wonderful Friday. It is bonfire weekend here in the UK, so I'll be setting out this evening with my family with a fireworks display, hot dogs and all things, candy floss and everything like that. So that's why I have a smile on my face with my sweet tooth. But I'm going to say have a lovely weekend. I'll see you all again next month with another fabulous guest and another update. Goodbye for now.